Years of low commodity prices and losses on the farm have some wondering whether the agricultural boom-bust cycle of the 1970s and 80s is repeating itself. The balance sheets say probably not. There are some big differences between the farm crisis of the 1980s and the current situation in Middle America. Then, as now, commodity prices had slumped after soaring for a few years. The price of farmland had skyrocketed too, just like now. However, unlike today, interest rates were high and farmers were deep in debt when the price of farmland finally bottomed 42% below its high. Gary Schnitke wanted to know what would happen today in that kind of worst-case scenario, so he ran the numbers.
The solvency issues today differ because if we look at the same sort of price decline on farmland, actually a little bit bigger, that we had during the 1980s and just did it to our typical balance sheet on our farms today, what we would see is the debt-to-asset ratio would go from 0.20, which is what it is today, to 0.26.
This is an increase, and it would cost the typical grain farmer in Illinois $1,300 an acre, but it would not lead to insolvency or bankruptcy issues.
And a lot of that has to do with a lot lower debt now because we have very low debt-to-asset ratios, and also because a lot of our farms have relatively small portions of their land base owned. Typical farm in Illinois has about 26% of its acres owned. And so, even if that 26% decline, there's, a lot of acres that they control that aren't being subject to that price decline.
Over a 7-year period in the 80s, the value of farmland fell 42%. The University of Illinois agricultural economist used a decline of 50% for his calculations. The resulting debt-to-asset ratio moved the needle from the great to the okay mark, not even as bad as the early 2000s on the farm. For University of Illinois Extension, I'm Todd Gleason.